Hi, I'm Derek Wilson, CEO of Synergetic. We've been working with the Urban Land Institute and industry to develop the Preserve tool over the last 18 months, which allows us to quantify the net zero transition in real estate investment models. And today, we're going to be walking you through the tool's key concepts, along with each tab and how to use it. So let's get started. Before we dive into the tool itself, let's take a quick look at some of the key principles and features that guide the tool. In terms of key principles, the first one to bear in mind is that Preserve applies a brown discount, not a green premium. So when the asset becomes misaligned, a brown discount is applied, and it's not the other way around. So we don't apply a green premium when the asset is net zero aligned. And ultimately, that leads into the second key principle, which is that adjustments get made when the asset is misaligned. So any year where the asset is not aligned with the selected net zero pathway, the adjustments get applied on the basis of whether the asset's misaligned or not. And if it is misaligned, a brown discount gets applied. In terms of key features, the first one we want to talk about is three pathways. Preserve incorporates three pathways, which represent different decarbonization strategies to compare the cost and benefit of different decarbonization approaches. The first pathway is do nothing. In this case, there's no net zero investment, and this really helps show the full extent of potential transition risk. The second pathway is a rolling 1.5-degree pathway. So this is a fully automated pathway where net zero investment is made incrementally using a cost calculator. This keeps the asset fully aligned with net zero all the way throughout the asset's life cycle and pretty much reduces all the risk that the asset is exposed to as a result of that brown discount. The third pathway is the user-defined pathway, and this is where the user can enter custom net zero investments, which really gives a more realistic analysis in terms of what might happen on the ground and in practice. So with each of these pathways, they are essentially checked against what are called risk drivers, and these are what determines whether the asset is aligned or misaligned. There are 5 different risk drivers that users can select from, and the default is the CREM 1.5 carbon pathway. So this driver essentially checks to see whether the chosen decarbonization investment pathway leads to the asset becoming misaligned with the CREM 1.5 carbon pathway. And in years where it is misaligned, those adjustments are applied. There are 4 other risk drivers that you can select from, with the 1.5 carbon pathway being the default. There's the CREM 1.5 energy use intensity pathway, and you can also enter in custom carbon pathways, custom energy use intensity pathways, and custom EPC minimum requirements if you want to model transition risk and misalignment on the basis of something else. The next key feature to talk about is risk categories. So these are the categories of risk which kick in when the asset becomes misaligned. There are 3 broad risk categories that get triggered when the asset is misaligned. The first is occupier risk. So this relates to occupier expectations and demands relating to net zero. And depending on the scenario you select, that will impact on rental rates and vacancy allowance. The second risk category is investor risk. So depending on whether investors care about net zero or not, when the asset becomes misaligned, the exit yield may be adjusted. And the final category is regulatory risk. So when the asset is misaligned with the selected driver, financial penalties may be applied, and that will in turn impact net operating income for the asset. And the final component I want to talk about is risk scenarios. So this is the magnitude of impact that happens when the asset becomes misaligned. So for each of those risk categories, you select a risk scenario, which ranges from no impact to high impact, in addition to a custom impact option where you can apply your own set of assumptions. Now, each of these scenarios is tied to a specific set of assumptions and adjustments which get applied when the asset is misaligned and gets applied against this specific category where you've assigned a scenario. So with that, we'll dive into how to use the tool. And at a high level, there's 4 key steps. The first step is to enter your baseline data. So this is financial data, decarbonization, investment planning, and optionally some alternative benchmarks. The second step is to review and edit the assumptions within the tool. The third step is to select scenarios and assumptions that you want to be using for the analysis. And the final step is to review the outputs and the analysis. So let's dive in. When you first open Preserve, you will start on the Introduction tab, and this is where you can get key information about the tool. You can also see the organizations that were involved in supporting, piloting, and creating the tool, along with a summary of how to use key principles and a summary of the key features that I just discussed. The first step, as mentioned, is to go to the Preserve Input tab. There are 4 key sections within this tab, and I'll go through them one by one. The first one is to enter key asset information. Up at the top, you will see a bar where you can enter things like asset name, the country that the asset is located in, the asset class, and the floor area. There are also some additional items which require a little bit of more explanation, so I'll touch on those briefly. The first is the GRR assumption. Now, that essentially says whether the data that you're entering in relation to rental revenue is based on actual occupancy or based on a 100% occupancy rate. So you can select that, and that will essentially provide the tool the calibration it needs to adjust the rental revenue accordingly. The second item that I want to touch on is reference asset value. So near the tail end of the analysis, what will be calculated is value at risk, and that is the percentage of the asset's reference value that is essentially used to calculate that percentage of value at risk. Now, the reference value for a standing asset that you're looking to model out is probably going to be the asset's current valuation. But if you're looking at a value add deal or essentially a retrofit project, the reference asset value that you want to be using is probably the target valuation that you're aiming for at the end of that analysis. Additionally, there is discount rate, and you've got the option to select a currency. So you can also switch the currency over to British pounds and enter in an exchange rate optionally. And then in the final section, this is all about the initial starting position of the asset in terms of its performance on energy. And you start with your initial EPC and enter in the energy demand broken down by source. So here you have total energy demand and then energy demand by source, including on-site renewables, from electricity, from fuel, and from district energy. The final note is that you can also enter the energy cost pass-through to tenant. So what this does is it essentially attributes cost to tenants rather than the landlord or the asset owner based on that percentage. So if your tenants are paying all of the energy costs either directly or indirectly, that would be 100%. But if you want to incorporate some landlord energy costs, you can include that there as well by reducing it below 100. That's the first section. And if you require any further guidance, to the left of row 4, you can click the plus and it will pop out with a little bit of additional information to guide you along the way. Beneath this section, we have financial input. And this is basically where we put in the key financial information that we need to undertake the analysis. The first row is gross rental revenue, so that'll be your top line revenue rate. Vacancy allowance, so the essential opportunity cost of the vacancies, so the revenue that you've foregone due to vacancy in the building. The net operating income for the asset, and that's after all the other expenses, not just the rental revenue and vacancy allowance. So if there are additional costs like management fees, typical operations and maintenance, include that in there, and then you have the net operating income, which is below all that. So those are the 3 key lines that we need in terms of kind of annual cash flow. But then we've also got some additional information that we need. So we've got the annual tenant turnover, and this is the percentage of the rent roll that is either up for renewal or is getting relet. And we need that because when we talk about rental revenue being impacted by transition risk, that typically only happens during a leasing event. So what we need to do is know how much of the rent roll is turning over in any given year so that we can apply a adjustment to the rental revenue on a pro rata basis. So only the rental revenue that's actually being renewed or relet. Beneath that, you have disposal or exit percentage, and this is where you can essentially specify how much of the asset you might be selling in a given year. So in this particular example, when we look at 2040, we have a 100% sale. So we're selling the asset in 2040, and beneath that, you also have the exit yield at 6%. So you can calibrate that depending on what you expect the exit yield to be. Now, you don't necessarily need to enter in disposal or exit percentage if you're not planning to sell the asset. You don't need to enter annual tenant turnover if there is no turnover amongst your tenants. And you only need to enter the yield in years where you're actually disposing of the asset. But ultimately, those things are quite important in terms of measuring certain facets of transition risk. And that essentially summarizes the financial input. Now, beneath that, and this does look a little bit more complicated, but it's not too bad. So
essentially this is where you set out your user decarbonization pathway. So whatever the decarbonization investment plan you might have for the asset. Now you don't have to fill this in, but it's quite strongly recommended because a user decarbonization pathway is generally going to be much more accurate than the automated pathway. It's going to be much more realistic and a much more appropriate assessment of the risk that your asset is facing. So what you do here in any given year that you're planning to retrofit the building, you first of all enter the amount of retrofit investment that you're planning to spend. When you do that, the rest of the column opens up for you to fill out information. And what you see here is that there's a €200,000 investment in 2030 in this example. So beneath that, a lot of these lines are optional. So you could include temporary revenue losses from retrofit in case you're giving a rent break to your tenants because of the disruption, for instance. And you can also enter in other recurring income and other recurring costs from retrofit. So for example, if the retrofit means that your maintenance bills are going up or down, you could put that in as an income stream or cost stream. And if you're getting annuities from some of the investments like on-site renewables, for instance, you can enter that in as well. Beneath that, you have embodied carbon of retrofits. You can enter in kilogram CO2 equivalent in terms of the embodied carbon. Again, that's optional. And then you have beneath that some pretty important information. So you've got your EPC rating after retrofit, and then you have your energy demand. So this is basically going to be compared to your initial energy demand that you entered up here to determine how much you are reducing emissions by switching energy, and also by reducing energy demand overall. So you can again set this out depending on the different energy sources that you are using post retrofit, and you essentially do that for any year where you have a retrofit activity. So in this example, we only have one retrofit happening in the asset's life cycle, so that's all you have to enter. And then the final section on the input tab is the benchmarks and penalties section. So in this section, you can enter in those custom benchmarks, which are used as those drivers that I mentioned. So these are optional drivers that you can use at the end and essentially use these to drive the misalignment years and therefore the adjustments. So you've got those three custom benchmarks that you can use later on, which are the GHG intensity target, the energy use intensity target, and the EPC minimum target. And you can fill those in as you see fit, and those might relate to a local policy, for instance. It might relate to something that your tenants really care about, a different standard that's not CREM, so on and so forth. So you can really kind of use that to kind of calibrate what you're looking at. And then finally, there's one item down here, which is established regulatory penalties. So if you happen to know that when your asset is misaligned with a given driver, that you're going to be hit with penalties that are either currently on the books or in place and have already been implemented, you can enter that in as a fixed amount per year. So in this case, what we're saying is that there's a €10,000 fine per year starting in 2029 for misalignment. And you might say, for instance, that that is based on the EPC minimum target. So you can see that if you aren't hitting that EPC minimum of D in 2029 and C in 2030, you're going to get hit by a €10,000 fine. To illustrate. So this is an illustrative example, of course, but you can put in any fixed fine that you want to plan for when the asset is misaligned against a specific driver. And that essentially is step one. So generally speaking, users find that it takes about 25 to 30 minutes to fill this out if they have all the data to hand. And from there, you can then jump on to the assumptions, which is actually an optional step. So in the Preserve Assumptions tab, this is step 2, you can basically in here see all the different assumptions that the Preserve tool uses to make its calculations, and you can also enter in your own custom assumptions if you want to use those instead. So the first couple sets of assumptions that we have are those that are relating to the scenarios and the kind of future projections around transition risk. So we've got the occupier risk scenario assumptions set up here. And you've got essentially two kind of areas where the cash flow is being adjusted, which is the rental rates and the vacancy rates and the vacancy allowance. So what you see here are the assumption sets for what happens to the cash flow when the asset is misaligned. And of course, it goes over time, the assumptions change over time, but it gives you a high-level overview. And you can see that in the case of rental rate differentials, for instance, and the no impact scenario, there's no change. The rental rate stays as €1 when the asset is misaligned. But when you start looking at like the high scenario and you go to 2035, for instance, in this particular case, essentially, if your asset is misaligned, you're getting 90 cents on the dollar versus what you would get if your asset was aligned. So this basically shows the kind of relative rental rate that a misaligned asset achieves relative to an aligned asset. And the same goes for vacancy differentials. So this is essentially a multiple of the vacancy allowance. And of course, if the asset's misaligned and it's less desirable amongst occupiers, that vacancy allowance will go up. And this is, again, a multiple. One thing I should note is that all the assumptions that you see here in terms of the rental rate differentials, vacancy differentials, etc., are all asset class specific. So whichever asset class you selected in the first tab, this will show you the assumptions that relate to that asset class. So you don't need to view all the different assumptions for the different asset classes, but each asset class has its own set of assumptions. You then go down into, similar to the occupier risk, the investor risk. So this is the exit yield differentials. So this is essentially where the exit yield will expand because the asset is misaligned and the investor cares about net zero. So again, these are multiple. So with no impact, it's 1 as per usual. But when you start looking at the high scenario, for instance, you're starting to see that by 2035, 2040, the exit yield is going to expand by 1.11, 1.12. So you'll see that essentially the asset becomes devalued when it's misaligned, when the investor is looking to acquire it and they have that preference for net zero. Then finally have mass penalties, and this is the final scenario-based factor or set of assumption set that we need to look at. And this essentially calculates regulatory penalties as a percentage of net operating income. And the reason that we chose this is that the penalties that we are seeing kind of come up on the horizon are quite varied in terms of how they are formatted, what they're based on. But some of them are fixed fines, some of them are a percentage of income, some of them essentially just prohibit you from letting the asset, in which case that's 100% of NOI. So we've developed out an assumption set, drawing both on historical kind of analysis, future-looking policy reviews, and surveys with professional investors as to what they think might happen to derive this assumption set. And essentially what you see here is that the penalty for non-compliance or misalignment can go up to 100+% of net operating income. And this gets applied after all other adjustments. So this is kind of the post-adjustment NOI, and the penalties are calculated on that basis. So that's the final scenario-based set of assumptions. And then we're getting into some of the other assumptions, like carbon pricing and emissions factors, etc. So what you see here in the carbon price is the default carbon price, and for all assumptions, you can actually see next to it where the source, where the data is coming from. And in this case, what you can see is that somebody's entered in, for this example, a custom carbon price for each year. And you can do that with every single one of these assumptions. You can enter in your own custom value. And in this case, that has happened. So you can see the default value, you can see the custom value. And that applies for emissions factors for electricity, fuel, and district, as well as cost for the different energy sources. So in any of these cases, you can enter in your own custom values, and in particular, the district emission factors. If you have district energy systems, it's really important to get that local emissions factor because they're very mixed in terms of different geographies. So you want to make sure that you're getting one that's locally applicable. And that essentially is the assumptions tab. So you don't have to do anything here. You don't even have to look at it if you don't want, but it allows you to understand the assumptions that are being drawn through and also specify your own custom assumptions so you can select them if that is your preference. And then we'll go on to the output tab, and this is kind of where the magic happens, so to speak. So if you go to step 3A, you can see here scenarios and advanced settings. So essentially for each of the three categories of occupier, investor, and regulatory risks, you have to select two things. The first is the driver. So what matters when assessing this category of transition risk? So when you think about this the relevant stakeholder like occupiers, investors, regulators, what do they care about? What are they going to make financial decisions on? So you can select from here any of the pathways, and note that the custom carbon, custom EY, and EPC pathway, you have to enter as the user. So if you haven't entered those, they won't work. But we might say, for an occupier, for my tenant of this residential building, what they really care about is actually an EPC. That's what's going to influence their decision making. And then once you've selected the relevant driver, you then have to choose the scenario that will essentially result from that driver. So is that a no impact, low, medium, high, or custom impact scenario? And again, if you don't enter in the custom impact assumptions, that custom impact won't work. But you really want to kind of take a view as to the local market and whether net zero alignment, or in this case, EPC status, is going to really materially affect their decision making. In this case, I might say that, yeah, it'll have an impact, but it'll be pretty low. And there's actually guidance in the introduction tab at the very bottom indicating when to select the relevant scenario. So you can actually refer back to the introduction and get that information and guidance on which scenario to select. But in this case, to illustrate, I'll select low impact. When we then turn to investor risks, we might say that investors really care about CRREM carbon alignment. They want a net zero asset, and CRREM is the standard that they're looking at. And then finally, we might look at regulatory risks. And we might say that actually, in this case, the regulators, if we go back to the input tab, the regulators have a custom energy use intensity benchmark, and that's their requirement. And if we don't meet that, they're going to apply penalties. So what you can select there is the custom energy use pathway. So you've applied the local policy in this particular example, you select the custom EUI pathway, and then that basically reflects the local policy. And we might say for investors, the impact is medium, and the regulators, the impact is, let's say, low. And then beneath that, you can go to advanced settings. Now this again is optional. And for each of these, you can select the scope of calculation. So for carbon pricing, you can select no carbon pricing, excess emissions only versus the CRREM curve, operational emissions only, or operational and embodied emissions. In this case, I might go with operational emissions. And the assumptions, you can choose the CRREM carbon price and pathway or the custom carbon price and pathway. And bear in mind, again, if you haven't entered in your custom pathway and your custom carbon price, it won't work. Then with respect to energy costs, you can calculate it on the basis of landlord energy costs only. So in this example, we said that 80% was passed through to tenants. What this means is, are you calculating energy cost savings on the 20% paid by the landlord? Or you can also select landlord and tenant energy costs. So I'm going to select that in this case. That gives us the full scope of energy cost savings. And again, you can select CRREM energy costs or custom energy costs. And finally, you can select emissions factors, and in that case, we can go with custom emissions factors or CRREM. I'm going to go with custom because we have some district heating there, and we've got that assumption. And another thing to note is when you do select custom assumptions or custom energy costs, if you haven't entered in one, but you've entered another, it'll just take the defaults for where you haven't entered it. So in this case, I put in custom emissions factors for district energy. Because I haven't entered them in for electricity or fuel, it'll ultimately pull those through. And with that, we're ready to go and ready to look at the analysis. So you've essentially got a couple of different sections here. And the top section is the core financial KPIs. So this essentially shows you the key financial metrics that show what happens under different pathways. And just as a reminder, the do nothing pathway is no investment in decarbonization, and everything essentially remains static. Rolling 1.5 degree pathway means that you're every single year investing more and more in decarbonization, and you're maintaining perfect alignment with the CRREM 1.5 pathway. So the asset never becomes misaligned, and adjustments, brown discounts, are never applied. And the final one is the user-defined pathways. That's the one that we entered in where we had that single retrofit intervention. And what you can see here is the financial results, the KPIs for each of these pathways. So for the do nothing, the decarbonization CapEx is 0, and in terms of the risk that gets avoided, it's also 0. When you look at the rolling 1.5 degree pathway, and these are all in present value terms, using a discount rate specified in the input tab, the rolling 1.5 degree shows 196K in CapEx in present value terms. And then what it shows you is established risk avoided, scenario-based risk avoided, and total risk avoided. Now, just to talk about these briefly, established risk avoided, and you can see this if you zoom in, it's got a little description under there, but that's the present value of established transition risks that the decarbonization investment avoids. So these will be things like energy cost savings, which are pretty certain, carbon pricing, which is relatively established, things like that. And you can actually see them down here. And of course, there's potentially exit revenue changes due to those. So if you're essentially saving energy and you go to capitalize that, that's going to yield a positive outcome. So this essentially captures that established risk, that established benefit versus the do nothing pathway. And that is kind of the anchor value. So if you're trying to justify an investment in decarbonization, if that established risk avoided meets or exceeds that, that means that you've got a pretty reliable payback on that. And that's without even looking at kind of future scenarios. You then have the second column, which is scenario-based risk avoided. So this is looking at the risks of different scenarios, and that's what you selected over here. So these are kind of future-looking scenarios, and depending on the scenarios that you selected, that will influence this scenario-based risk avoided. And this is kind of more future-looking and very kind of predictive in a sense. So it's looking long-term, what might happen in the market, and how could that potentially impact on the value of decarbonization and the value of misalignment. This then gets totaled into total risk avoided, so that's established plus scenario risk, and then you get a payback multiple in terms of the decarbonization capex to the total risk avoided. And what you can see here in both cases is that it comes back. But if you start playing around with the scenarios and you go no impact on occupier and you go low or no impact on investor, suddenly you get a slightly different analysis and different scenario-based risk avoided and a slightly different payback multiple. Now, in addition to that analysis, so what you have at the far right is the net present value of everything other than the decarbonization capex. So all the kind of upside and downside risks, the energy cost savings, the capitalized energy cost savings, the occupier and investor and regulatory risk, and it then gives you an expression of the value at risk, and that's as a percentage of the reference value that you entered into the first tab. So what this shows is that in the case of the do nothing pathway, we have 3.3% of the asset's value at risk. And in the case of the rolling 1.5 degree and user-defined pathway, we have negative value at risk, which means we're actually adding value to the asset overall when we undertake this analysis. But if we start tweaking the numbers and we start putting occupier as medium and investor impact as high impact and regulatory as medium impact, you can suddenly get a very different outcome where the results start getting much, much larger and the value at risk changes potentially quite significantly. Now, to the right of this, you actually have a breakdown essentially summarizing all of this in a chart. So you have a summary of the decarb capex, the established risks or potential upside in the case of energy cost savings and those being capitalized. And then you have the occupier, investor, and regulatory risks. So these are essentially the scenario-based risks you picked over here in the pink on the chart to the right. And that basically shows you your risk exposure and what happens in present value terms to your cash flow over the hold period under the three different pathways. And what you can see here under the do nothing is that you're having a pretty substantial loss, primarily coming from the investor and regulatory scenario risks. Whereas if you look at the other ones, you see a bit of downside due to the capex, a bit of upside due to those energy cost savings, and a little bit of investor and regulatory risk under the user-defined pathway. And you might ask yourselves, why is that? And that's where you can look at the alignment diagrams. So these show how the different pathways compare to different targets or benchmarks. So this chart shows both the CREM 1.5 degree carbon target emissions and the custom target emissions that we entered in the input tab. And you can see here that the user pathway emissions, there's an investment here, and the asset actually misaligns a bit later on in the period. So it actually misaligns and there are negative adjustments applied after 2037. So that will result in a bit of negative adjustments. So it's not a future-proofed decarbonization strategy. Whereas the rolling 1.5 emissions, which always follows the CREM emissions curve, it remains aligned and never gets adjusted. So you can see there why that the rolling 1.5 pathway actually has less risk than the user pathway. You can also see beneath that the energy use intensity pathway versus the targets. And again, you can see the CREM 1.5 energy use intensity and the custom target EUI. So in this case, all three pathways, the do nothing, the rolling 1.5, and the user pathway, they all are continuously aligned with the CREM energy use intensity pathway. But they do run into issues depending on the pathway with the custom target. So this is really useful to look at to see when is your asset becoming misaligned, when is it becoming realigned, and how does that impact on your kind of misalignment dates and therefore when adjustments are being applied. So once you've had a look at that, you can then go down into a slightly more detailed breakdown, which is the transition risk breakdown down here. If you want some additional guidance, you can always press the plus button to the left. This is noted up here, and it gives you a bit more of a detailed description as to what each of these represent. But at a high level, I'll talk you through it. So for each of the pathways, again, you see decarbonization CapEx, which is the same as up here. But then we have what are broken down. So this established transition risk avoided, that's essentially the delta between these pathways, ruling 1.5 and user defined, the delta between those and do nothing. So what you see here are the absolute risk figures. And what you can see is that in the do nothing pathway here at the top, you have 168,000 euros in risk, essentially, just focusing on established transition risks. Those are existing regulatory penalties, energy cost savings, carbon pricing, and exit revenue due to those NOI changes. When you then compare that with the ruling 1.5 degree and user defined, what you see there is that actually you have energy cost savings, so positive adjustments, and those get capitalized, so ultimately they have a positive value. So when the aggregate established transition risk for ruling 1.5, which is 237, is we subtract that from the negative 167 under the do nothing, and that essentially gives us that established risk avoided. You then move over to the scenario-based transition risks. So these are fully driven by that scenario selection panel we saw at the very beginning of this tab. And what you see here is that under the do nothing pathway, you have some vacancy allowance impacts, some exit revenue impacts, and you've got some future regulatory penalties. Those kind of accumulate into that negative 2.5 million figure there. We then again, similarly for established risk, we compare that under the do nothing pathway to the 1.5 and user defined pathways. And what we see is that there's a pretty substantial delta between the two. So that delta, that avoided risk, is captured in the table above. And of course, when you add them together, the established risk and the scenario-based risk, that gives you your net present value over here. So this is the sum of the established transition risk and the scenario-based transition risk. Finally, you can go all the way to the bottom, and if you really want to get into the granular detail, you can look at the detailed financial adjustments of each of the pathways. You can see a line-by-line, year-by-year breakdown of what adjustments are going on. You can see exactly what's happening, and if you see some anomalies, you want to understand where something is coming from and when it's happening, you can go down to these tables and view all the way through the hold period to understand exactly what's happening and when for each transition risk item. And that's the end of the output tab. You can, of course, if you want, go to the back end and look at calculations. You can figure out how everything is pieced together. All the formulas are there, and you can hopefully piece together exactly what's happening if you want. There's also a database of various data values here in the back as well. You can have a look at that if you would wish. But ultimately, what you want to be focusing on here is the outputs. And using this scenario and selection panel, you can then essentially shape the analysis, use that to test out sensitivities, and get a pretty robust understanding of the transition risk facing your asset under different decarbonization strategies, understand the payback potential that you might get by investing in decarbonization, and of course, understand the cost of doing nothing. So with that, I will leave it there. And as always, if you have any questions, you may reach out to the team at preserved@uli.org. Thanks.